Monday. This is Jay Brew, co-chairman of Seafried and Brew. With the strategic planning season starting, what I wanted to talk about is one of the things that we feel is really vital in the whole strategic planning process. And what this is the management team meeting, where the management team gets together, airs views in terms of what's happening, looks at a number of different factors that we're going to outline to you, and then basically gives communication up to the board in terms of their feeling where the bank's strategy should be heading. So when you look at this, what type of meeting and what type of structure is good to have with that management team? Well, what we did is that we normally go out and do questionnaires and receive comments from the management team before we facilitate the session. And from that, this year, the comments that we're getting back lead you into then sitting there saying, what should the agenda be for that meeting? What is on everybody's mind is the economy. And different than how we've done it in the past is that our belief is that this is a good breakout type of session with the management team, breaking them into groups of 5 or 10 depending on the size of the management team, and then sitting down with the different groups, coming back together again to discuss what everyone was talking about at the individual breakouts. So when we look at it, that to go over the economy, because this is really going to determine how you're going to really structure your strategic plan into 2012 and even thinking maybe a little bit beyond, but the economy being a real major focus in terms of the loan side, the deposit side, and the investment side. So when we look at it and get that general feeling of the economy, then what we can do is to go and do the whole risk element. For this, what we use is the Seafried Brew Total Risk Index, as well as its components of capital risk, credit risk, liquidity risk, and earnings at risk. So we review that with the management team. But a big piece this year that should be added into this overall risk view is the whole aspect of capital. And to talk to the management team, do we have enough capital to cover the risk? And to look at it from all of those different factors, which then can be incorporated into the bank's overall capital plan. Because one of the things that we talked about in our book in terms of the art of capital is to essentially look at strategic planning as being the thing that creates the foundation for capital planning going forward. So the two are connected in a way that must be put in through the strategic planning process, but also from the standpoint of looking at this risk to capital, which of course is then captured in the capital plan. What we also do is that we look at our strategic planning model. And this strategic planning model that we've developed at Seafried and Brew is really a major part of the strategic plan, as well as going into the board retreat and then the management retreat's agenda. So we want to look at how the balance sheet, income statement, capital accounts are going to move here over the next 5 to 10 years. And then to sit there, especially if you did this last year as an exercise, to sit there and go through where did we underestimate, where did we overestimate, where are we outperforming, where are we underperforming in terms of where we set our strategic model last year, and then to sit there and say, what should the expectations be in the model going into 2012 based upon what we're seeing now. And that then can be communicated up to the board. The other element that we're hearing a lot of from management commentary is the whole aspect of, are we going to remain independent or not? And my feeling is, instead of taking the view of having a breakout in terms of, gee whiz, are we going to remain independent, is to really come up with what I would call a top 10 list to send to the board. And that top 10 list can essentially lay out in here the reasons that the management team feels that the community bank should remain independent in its marketplace, so that then the board can see how the management team is thinking about reasons why to remain independent. So that top 10 list, what you might call the top 10 message to the board, essentially lays out what management thinks are the most important things that the board should be considering from their point of view in terms of remaining independent in here going forward. So I think it's an interesting opportunity for the management team to sit there and give their views up to the board, and then of course taking it to the actual strategic facilitation to the board and reviewing that with them and getting a discussion going around what the management team's feelings are. So when we look at this as an overall basis in here, that once again, this gives the management team an ownership in terms of their part of the strategic plan that then gives valuable input to the board. So when we look at this economy piece, for instance, okay, how would you structure the discussion around that particular area? Well, as we've been going through, looking at the Treasury yield curve in here, and of course there's big news even compared to when we did our webcast last week. Because as you remember, we were sitting there saying that at a 3%, the 10-year was very oversold in here. Amazingly enough, yesterday, before we got the unemployment numbers, we saw a steep decline in here, getting down to a 240. Right now, we're right around a 249 in here. But still, this amazing drop because of how the markets are viewing the economy. And also people remembering that the stock market, the Dow dropping over 500 points on Thursday, really was a scare in here. And my feeling is, which I'll go into in a minute, is that this feeling of doom and gloom is really way overdone. On the other hand, what we had on the short end of the curve is T-bills declining. Remember last week we talked about T-bills moving up a couple of basis points over the whole government shutdown situation and the debt ceiling. Well, they've moved back down. In fact, on Thursday, in the midst of the whole Dow problems, there were times when short T-bills once again went into the negative category, with now the 3-month T-bill right around a 0.01 going out to that 0.12. The other area that has had a pressure downward in here is that we set a record on Thursday, but we're now right around 0.28 on the 2-year. So as you're discussing this with the management team, where do they feel that this is going to be heading? And to go through on those economic breakouts is to sit there and say, what kind of yield curve do we expect to see as we move into 2012? How do we look at deposit pricing? Once again, it's our belief strategically that community banks should be dropping their short-term deposit rates because no one's paying any higher rate of interest out there on short-term guaranteed type deposits than what community banks are paying right now. So I think that the question is to have that discussion with the management team is very valuable. Along with that is that we were all waiting for the unemployment report. And on the headline, what happened is that essentially we had unemployment decline from 9.2 to 9.1. Slight positive sign. We also had non-farms increase 118,000. Also a positive sign, better than what the street expected. But then what happened is that suddenly people started looking at these numbers. And what we saw in terms of overall employment is that the prior month, 139 million people employed, and when you looked at the number this month, it was 139 million people. So and the overall employment, there was actually a decline of 38,000. Doesn't look the same as this, does it? Well, it skews those numbers in terms of how they're calculated. So that when you looked at it, the major thing that made this drop was that those discouraged workers that stopped looking for jobs actually increased in here 137,000, that skewed all of these numbers. So when we really look at it, it's sort of a wash. You could actually say unemployment got worse. And following what we've been talking about over these past many weeks is that the longer that this situation remains intact, the longer that interest rates will stay down, pushing it well into 2012. So then the question is that, well, where do we go from here in terms of the direction of one person? And when we look at it also from the standpoint of our recession threat index, because there's a balance between that one person that we'll talk about in a minute and what we're seeing with Dr. Ed's recession threat index. You can see here that back in 2005, 2006, going into 2007, that our recession threat index was definitely showing a lot of move up in here and a lot of volatility, but overall on the upside, which was really pointing to the overall recession that we went through. Once again, in terms of timing, you see how this declined dramatically and then the recession ended. Well, what are we seeing here now? Well, when you look at it, we went through that period in 2009 where the economy was improving, so the recession threat index was very low. We then went into that period last summer where a lot of people were saying, we're going to go into a double dip, we're going to go into a double dip. We sat there and said, no, that's not the case, because really when you compared this to these levels, it was not suggesting that a recession would happen. You can see here the most recent numbers, once again being sort of bouncy but still relatively low, which would indicate to us that there is not a chance of going back into recession, even though so many people, especially in the midst of the furor with the stock market, etc., just felt that everything was just going to go right back down again into a recessionary period. So once again, keep your eye on our recession index. It's available on our website under Dr. Ed's economic charts. So who is that person? Well, when you look at it, is that one person is Mr. Bernanke. And all eyes are going to be on him, because what started coming out in the news is that will the Fed do another stimulus program in here with all of this bad news coming about? And when we talked about and showed Mr. Bernanke's picture a while ago, many of you remember that I was talking about the whole aspect of the rose-tinted glasses. So what kind of glasses are the Fed wearing right now? Where is Bernanke on what is happening in this economy and which way it's going, and that if on the base level that employment is not improving? One could argue that QE2 did not work. One could argue that QE2.5, which is still having the Fed buy securities in the marketplace to keep their portfolio even, hasn't worked. So what will the Fed do in here, and what kind of impact will it have? Will it be able to revive the economy in any way? This is Jay Brew. Have a great week.